When you invest money, you're really choosing what role you want to play. You can be an owner or you can be a lender. That single difference explains almost everything about stocks and bonds. A stock makes you an owner. Buying a stock is like buying into a high-growth startup. You're saying, I believe this business can grow, become more valuable, and maybe dominate its market. If that happens, your piece of the company can be worth a lot more. But there's no promise. The company might struggle, competition might win, or the whole economy might slow down. As an owner, you're along for the ride, good or bad. That uncertainty is the risk, and it's also why stocks can deliver higher growth over time. A bond makes you a lender. Buying a bond is like giving a steady loan to a government or a large company. You're not betting on explosive success. You're agreeing to lend money under clear terms. They promise to pay you interest on a schedule and to return your original money on a specific date. Your upside is limited, but the path is usually smoother. You care less about growth and more about getting paid. This leads to a useful phrase. Stocks are about what you own. Bonds are about what you're owed. Owners don't get guarantees. Lenders do, at least on paper. Risk shows up most clearly when things go wrong. If a company fails, lenders get paid first. Owners are last in line and often get nothing. That's why bonds are generally considered safer, especially high-quality government bonds. But safety has a trade-off. Bonds mostly give you interest. Stocks have no ceiling. A successful company can grow many times over. So think of it this way. Stocks are riding in the startup's car, exciting but bumpy. Bonds are holding the loan contract, calmer, steadier, and designed to pay you back.